For Morningstar, I'm Christian Charest. Exchange-traded funds that invest in bonds have exploded in popularity over the past few years. So far in 2016, about half of all new money going into ETFs has been going into bond funds. To talk about this, I'm here today with Mark Noble. He is a Senior Vice President and Head of Sales Strategy at Horizons ETFs. Mark, thank you very much for being here today.
Always a pleasure.
So let's start with some numbers. How much money has been going into bond ETFs?
Well, Canadian ETF investors really like their bond ETFs. In fact, about 50%, so $1 out of every $2 this year, has gone into fixed income ETFs. And overall, Canadians actually have the highest proportion of fixed income ETF assets in the developed world. So the global average for fixed income ETFs is about 17%. In Canada, it's 30%. And in the United States, just to give you a similar demographic example, it's about 16%. So about twice the global average. And flows over the last 3 years have been about 36% going into there. So a huge amount of money, about $16 billion over the last 3 years, has gone into fixed income ETFs.
And are there any types of bond funds that are more popular than others?
Well, I say the lower the yield, the bigger the inflows, actually, is sort of the metric that I tend to see. So a lot of the money is going into high investment grade in Canada, high investment grade bond ETFs, which yield about 2.5 to 3%. And I think the big reason for that is really the cost advantages of that. If I'm only getting 2.5% and a fixed income fund is charging me 1.6%, well, I'm losing half my yield to fees. So we've seen fee compression really drive people to be more attracted towards fixed income ETFs because they're keeping more of that yield.
And what about other types like high yield or actively managed funds?
Well, certainly we've seen more flows move into those nichier type of categories, a lot, particularly in the United States. I think high yield bond ETFs now top over $60 billion globally, which is huge comparison to where the global market is. But in Canada overall, it's generally led towards the investment grade. Active management has also started to attract a lot of product launches because of the nature of fixed income indexing, which sometimes isn't actually that replicable. So if I take something like the largest broad bond index in Canada, it holds about 1,400 names, but only about 1,100 are liquid enough to hold in an ETF. So we see already that sampling or trying to access that exposure can be difficult. So we're seeing on product size a lot of active products coming into the market because it's not necessarily possible to actually generate index performance.
That's a good segue into my next question. Bonds are usually seen as less volatile than stocks, but there are some risks to investing in bond ETFs.
There are big risks, and as I talk about that index one, that's probably the most biggest risk that I view for a couple of reasons. Number one, we've seen the duration on index products increase quite a bit. In fact, over the last year, we've seen duration, which is the number of years to maturity for the fund, increase a full year. Now, generally what happens is if interest rates rise 1%, you would expect to lose about 1% per year of duration. So if we even see a 50 basis point increase on something with a 2.8% yield, you're looking at about a 3.75% loss in that product. And so a lot of these index products, they don't look at duration. The other thing they don't look at is credit analysis or a valuation analysis. And again, you know, they hold the products that have the most amount of debt. Now, generally that would be a highlight of the fact that the issuer can afford to carry that debt, but necessarily if I'm building a portfolio, I don't necessarily want to buy the most indebted issuers, but that's how those indexes are created. So it's a lot of passive money going into a space that has some real risks. The other aspect always, of course, is also these are OTC, over-the-counter securities, where transparency isn't quite as well known as stocks. Now, ETFs have done a good job, though, of course, of improving that.
Mark, thank you very much for explaining all this to us today.
My pleasure. Thank you very much for having me.
For Morningstar, I'm Christian Charest. Thank you for watching.